Well, welcome to Retire Smart Magazine. My name is Steve Sexton, and this is the Saving with Steve segment. Today, we're going to be talking about that awful word, taxes. Now, taxes can be exciting. And when they're exciting, it means you get to pay less in taxes. In fact, downright, they could be sexy, especially if we save you $2 or $3 or $4 or $5 or $10 or $20,000 in taxes. And quite frankly, in my practice, we do that all the time. In fact, last year, we saved somebody almost $980,000 in taxes, which was wonderful. But a lot of times, I'm helping people save 10, 20, 50, 100, couple hundred thousand, 10,000, 5,000, $20,000 in taxes. What I'd like to do is just go through a number of things, maybe 8 or 10 items that you can do now to set yourself up to reduce your taxation in 2020. Okay, so let's just start talking about the deductions that you have the ability to take on your tax return. There's not a lot because of the Tax Cuts and Jobs Act. Some of them went away. Now let's take a look at this. Number one, deductions, medical. So this would be the time to take a look at all the medical bills that you've had in the last year. So that means doctor's visits, prescriptions, any therapies you paid for. If you're a regular visitor, subscriber to the chiropractic office, you want to get them all listed up, okay? And see if it would be a fit for your medical deductions. Next, when we're taking a look at your interest payments off your mortgage, all right? This is very, very important to take a look at and think about a little bit. Hey, if you make all 12 of your payments and make a 13th payment in January, say late January, you'd be able to write off the interest from your January payment that you made in December of 2020. So that means you're going to be able to deduct off more interest. Okay, now when it comes to property taxes, obviously we have a $10,000 threshold. Okay, so if your property taxes are already more than $10,000, this is going to do you no good. But for those people who their property taxes are under $10,000, think about making, in California, you pay your property taxes in December and April. Okay, in other states it's the same, maybe other dates, whatever. But here's the thing. If you make your April payment in December of 2020, you'll be able to write it off for the 2020 year. So make sure your property taxes are under $10,000, and that makes a lot of sense. If your property taxes is, $15,000, $20,000, $30,000, obviously you can make one payment, you're only going to be able to deduct $10,000. Okay? Now, charitable deductions. This is a biggie. Now, you have the ability to deduct, you could contribute as much as 60% of your adjusted gross income in cash to a charity, providing it's a 501c3, and take a tax deduction for that amount. If it's not cash, you can deduct property, clothing, land, all that kind of stuff to a charity and deduct up to 50% of your adjusted gross income. So if you have if your adjusted gross income is $100,000 and you donate $60,000 of land to a charity, hey, you're only able to take $50,000 in deduction this year, but next year you can take the other 10. Okay, so we've gone through those. Now let's start talking about loss harvesting. Okay, so for example, 2020 has been a crazy year in the market. We've seen all this social interaction-related businesses such as retail, restaurants, concerts, entertainments, travel. You know what? All their stocks, they've gone down. Some of them have been okay. And we've seen all the ones that don't require that to move forward, like the Overstocks, the Amazons, the Qualcomms, all those stocks has moved forward because, hey, they don't need social interaction to make their business flourish. In fact, many have done very, very well. But here's an opportunity. Some people right now are saying, hey, look, I want to take some of my gains off the table. So how do I go about offsetting the taxes so I don't pay that much? It's called loss harvesting. So you look at those stocks that have lost money. Say you have stocks that have lost a total of $10,000 in 2021. And if you sell them, you're going to take a capital loss. But if those stocks that have gained, you sell off $10,000 worth of gain, that $10,000 worth of gain will offset that loss and you'll pay zero in taxation. Okay? Another thing to take a look at. You know what? If you understand the tax brackets and as it relates to capital gains and dividends, you'll have the ability to pay no taxes. So here's the example. I have clients, many of them, they have about an $80,000 income, okay? But they take their income from selling off stock, which is capital gains, and dividends from the stocks that they currently own and Social Security. Because their adjusted gross income is right around that $80,000 level, or within that 12% tax bracket level, they pay zero in taxation. So they're paying nothing on the federal and $25 on state. Hey, that's not bad. I just netted $79,975 off my $80,000 income in retirement. Not so bad at all. You can do that too. You just have to pay attention now. Okay. So now we've talked about those things. Let's move on to contributions. So, for example, what about thinking about maxing out your health savings account or even starting one before December 31st? Because whatever you put into it, you're going to get a tax deduction for it. And you know what? If you don't use it and you're 65, you can roll it over into your IRA. Now, you have the ability, if you're married, doing it jointly, to contribute $7,100 each year to your health savings account. If you're single, it's $3,550 for 2020. It'll go up next year, but that's an opportunity. Contributing more to your IRA. Some people I've talked to don't even have an IRA, a 401k or 403b at their business, okay, or where they work. If you don't, and you want to save on taxes, one of the best ways to do it is set that up. So for example, I have one client is a teacher, and he's, this is the year he paid off all his debt, and he's like, Steve, I've got $120,000 worth of income, and I've got no real deductions. I said, hey, do you have a 403b plan? He says, no. I said, set one up. You can, because of your age, you can put $19,000 in there. That's $19,000 you won't have to pay taxes on. So that's really important. Now, if you're self-employed or your spouse works but you don't, as long as you set up an IRA before December 31st, put $50 in it. Come back at tax time before you pay your taxes and contribute up to the maximum that you can contribute. It will offset. You won't have to pay taxes on that for 2020. That make sense? Okay. For those people who took a COVID-related IRA distribution that either you were under the age of 59 and a half or more than your required minimum distribution, you have the ability to pay the taxes over a 3-year period. Now you can look at paying some this year. Now you want to take a look at your income. If whatever you took out is going to push up into the next tax bracket, you might want to push it to the next year, especially if you've been laid off or furloughed. Okay. Now, let's talk again about capital gains. We're seeing a large amount of people actually selling their homes, buying other ones. We're seeing people sell their homes in states like California, New York, Chicago, the high tax states, and they're moving to other places. And as a result, they're looking at, hey, if I've made more than $250,000 and I'm single, or $500,000 and I'm married, whatever's over that, I'm going to have to pay capital gains on. At 20% on capital gains. I got my state taxes here in California, that's 13.8. And if it's over $250,000, hey, you got net investment tax as well, so you're at 38%. Now, one of the things that you can do is you can say, hey, I'm going to do this year because I don't know what taxes are going to be next year, and they're likely going to be higher with the new leadership. So, hey, why don't we sell it this year and get that out of the way, especially since we have such a high real estate market. Here in California, we're seeing realtors are telling me that they're seeing people pay more than what the asking price is, which, the sellers, that's wonderful, okay? Now, other things that you can do. Some people are selling rental property, so besides having the 38%, they're getting hit with recaptured depreciation. Business owners are selling their business, looking to retire, and that might be happening towards the end of the year. Know that there's tax strategies that you can utilize that are legal, such as monetized installment sales. Okay, there are charitable remainder trusts, charitable remainder annuity trusts, charitable lead trusts that can cut your taxation down anywhere from about 7 to about 12% instead of paying 38%. I recommend you look into that for what you're doing so you can find or reduce or eliminate taxation on the sale of your highly appreciated capital assets. Now, let's take a look at some business owner stuff here, okay? Business owners, you know what, you used to have an office, but now you're operating out of your home because of COVID. There's an 8829 gives you the ability to write off your home office. So take advantage of that, but don't go overboard. Because if you go overboard, they're going to audit you. Looking at 15 to 20% of the house at maximum, make sure it's suitable for you. Next, for business owners, this would be a great time to look at what your deductions are compared to your income, extrapolate that into the next couple of months, and figure out how much you're going to owe in taxes. It's a wonderful time to get caught up on that because you got to remember, you got to pay at least 90% of your taxes before the year's out, okay? Otherwise, you're going to get a penalty. Next, if you're going to get rid of equipment, okay, you've got that $15,000 printer that you're going to say, hey, I'm going to go sell this at a loss. Well, if you sell it at a loss, it's a capital loss. If you just get rid of it, it's an ordinary loss. Capital loss offsets a capital gain, and ordinary loss offsets income. Could save you a lot in taxes there. Next, looking at bonuses. You know, many business owners, they run their whole business and then they take a bonus at the end of the year. Hey, depending on what happened this year and the income and everything, you might want to consider paying that bonus in January, taking that bonus in January. If you're working for somebody, hey, pay me in January instead of December, okay? Also, this is a wonderful time to set up things like defined benefit plans, cash value plans, 401k plans for employers. I just had an employer, they set up a defined benefit plan. They're having the ability to write off almost $200,000 this year because they're going to be contributing it into a cash balance plan. So there's many things that you can do. You just want to take a look at it. But most important, you want to start investigating those things now so you can get prepared to implement them before this holiday season gets crazy with COVID, family, the whole shot. Now, I want to thank you for joining me today. This is a Retire Smart magazine. Again, my name is Steve Sexton. This is the Saving with Steve segment coming to you this Thursday and every Thursday at 10 a.m. I'm going to give you my best advice to help you retire smarter. Hey, have a wonderful week. Stay warm. Bye-bye.